record rental income, expanding portfolios, steady dividends, 4RL commercial REIT. These are more than headline achievements. They're the foundation of a platform built for income-focused investors. Yet, beyond the impressive numbers, a single question drives the market. Will growth remain yield accretive per share as RCR continues trading properties for new shares? Rental income soared to nearly 8.86 billion pesos in 2025, up 34% year-on-year. 9 new mall assets integrated into the portfolio contributed to this surge. This scale advantage means tenant mix and location now play an even bigger role, boosting recurring lease revenue that forms the backbone of cash distribution. Operationally, RCR's stability is clear. Occupancy averaged 96%, with a weighted lease expiry of 4 years. These metrics anchor cash flow visibility, especially as post-pandemic shifts and retail normalization unfold. Dividend policy remains direct, paying out at least 90% of distributable income. In 2025, 4 quarterly dividends delivered a total payout of around 0.4268 pesos per share, with a modest step-up in the fourth quarter. What's crucial? The payout ratio hovered near 94%, leaving a buffer for reinvestment and contingencies. Here, dividends are tied to cash generation, not headline accounting gains. Behind the massive accounting figures, investors are reminded: focus on recurring earnings and real cash flow. RCR generated over 8.19 billion pesos in operating cash flows, up from the previous year. A signal that collection efficiency and portfolio scale are translating into liquidity, supporting dividend stability even as distributions grow. On the balance sheet, RCR stands out. Debt-free at year-end, with significant headroom for leverage if needed. Liquidity ratios remained comfortable, helping reduce refinancing risk and preserve expansion options should market conditions shift. But the real debate isn't about total pesos, it's about per share value. Asset infusions via share issuance can lift overall distributable income, but dilution matters. In 2025, earnings per share softened, from around 0.5051 to 0.4742 pesos. This doesn't spell trouble, but it reminds investors: not all growth directly boosts dividends per share. The market will watch closely for infusions that truly raise per share yield. Looking ahead, fundamentals matter more than ever. High occupancy, resilient rent spreads, and disciplined operating costs will be crucial. Sustainable dividend growth requires both new assets and smart asset management, releasing at higher rents, retaining high-quality tenants, and controlling expenses. The takeaway? RL Commercial REIT offers reliable yield, prudent balance sheet management, and measured growth. As the platform scales, dividend stability remains in focus. For investors, tracking distributable income per share and the accretiveness of new acquisitions is the scoreboard for real compounding. The path to sustained yield is clear. Growth must continue to benefit each share, not just the headline totals.